looking good generally overall. Our market master of the day is Sridhar Sivaram, investment director at Enam Holdings, and he's joining us right here in our studios. Sridhar, welcome to the studios. It's always great to speak face to face.
And good to be back after 2.5 years.
So. Wow. Great to have you here.
Thanks a lot.
And this is our new studio, so I think the last time you must have been in the...
I think he's been here.
I have been once, maybe just before COVID, I think I had come.
Wow.
He's been here.
But it looks great. I mean, the new studio looks really good.
Thank you.
How are things looking, Sridhar, in terms of markets now, after the pullback and a little bit of doubt over the last couple of days?
So our broad view is that the construct for India is looking great. I mean, inflation, we think for the month itself will come around 6 and it is trending lower. GDP growth looks like it's trending upwards. Consumption is looking as if it's coming back. But when we look at the global construct, it just doesn't look that great. I mean, just to put things in context, look at what is happening in China. I mean, that's a large percentage of the EM market. Actually, people don't realize, if you look at the Hong Kong China index, the COVID lows of March 20 was around, say, 8,000. We were also around 8,000 lows, or maybe 7,500, and we are at 17,000, and they're at 6,500 right now. I mean, that's the extent of decimation that we are seeing, and it's still going down. And I think lesser spoken about Europe, the better. I mean, every day there is a new crisis. Energy, I think they are in recession. US inflation still at 8.5. I mean, it is not 4 or 3%. People are cheering, but it's still way above their threshold limits. So I think when I look at the global construct, it's not looking that great, and it will be very difficult for India to move in isolation. So if there is issues globally, we will face the brunt. So I would say that this is more a buy and dips market. You have to be very careful when there is irrational exuberance, and one has to tread carefully. Our broad view was for 22 was that this is a tough year, and we still maintain that.
Okay, this is a tough year and still maintain that. Sridhar, good morning. So yeah, global construct clearly is still a bit iffy, but India has done well, right? In that sense, I wanted your thoughts on whether the market's leadership has changed, because started to see banks do well, consumption's been doing remarkably well, auto index at new high, FMCG index at new high, while IT is still about 25-30% of the highs. Do you think the leadership now is with domestic sort of inward economy facing stocks?
So our broad view for the last almost 18 months was value over growth. And if you look at the top, say, 10 Nifty stocks, you'll see things like Coal India, NTPC, a lot of the auto names, ITC, which nobody wanted to touch. Broadly, the value guys are on top, and growth is suffering. But our view in the last 2-3 months is that it's time to slowly get into growth. And the first of the block, at least that's our view, is the financials, which is the banks. So the private sector banks, which have had a lot of issues in the past, especially because of COVID, there were uncertainties, restructuring, NPAs. We've seen that they have come out of this, once in a millennium sort of crisis, very well. Especially the private sector banks have really come out very well. They, credit costs have actually normalized much faster than anybody would have anticipated. We think that the next 5 years is going to be great for large banks, be it private or maybe some PSUs. But I think within the financials, the banks look extremely good. Our view is just, hold as much as you can and stay put for the next 3-4 years. Very difficult to see losing money from here unless there is a global calamity.
Does that include tier 2 banks? Because that's where we started to see a big move. I know you won't talk stocks, but names like RBL, IndusInd, they have started to make a big move.
So I would say that any tier 2 bank or any bank which can access liabilities, that's going to be the crux. That if you are able to access CASA and your deposit cost is reasonable, then I think those banks will do well. Banks which are struggling to get their deposit base, within a reasonable price band, they will have issues. So that's how I will put it, rather than getting into tier 2, tier 1, or even smaller banks. If you can access deposits, if you can access liabilities, I think you're in.
Okay, but there are a lot of domestic consumption-facing sectors that are doing well, right? Whether it is autos, whether it's even some of these capex-related sectors, the L&Ts of the world. What would you pick now for the rest of the year?
So actually, we met a lot of the capex-related companies recently post results, and surprisingly, most have said that there are a lot of announcements. We are waiting for orders to come in. So the order follow through, and one of the large companies mentioned that post the Ukraine issue, many companies have pulled back, even though they have announced, but they haven't gone ahead with the actual placing of the orders. So I think it's a wait and watch right now. So I would say the domestic consumption, especially autos, looks specifically good. Within that, I would say that commercial vehicles and passenger vehicles, not so much on the two-wheeler, because they're facing, the competition from the EVs and the unorganized two-wheeler market, especially the, small sort of scooters which are floating all over the place. So I think two-wheelers have the issues, but the others are looking reasonably good, worth investing.
Sridhar, you said that whoever can access low-cost deposits, right? So which means that loans are not going to be a problem. Credit growth is not going to be a problem. So which are the segments which will be the fastest growing in your assessment?
You're saying in terms of loans?
In terms of loans, I mean, only businesses which do well or sectors which do well will need credit, right? So where should we look at? One segment which the market has gotten excited about is capital goods. But occasionally that excitement comes and then dips. What's your sense?
So I think what we are seeing is from a very low base, we are seeing credit growth come to closer to double digit right now. If this has to sustain substantially, then capex for corporates have to come back. We think that it will come back, maybe not as fast as the market is expecting. In the interim, it will be more working capital related and the retail, which will push the loan growth higher. And maybe beginning of the next year, or first quarter, which is the fourth quarter of this year and the first quarter of next year, we'll start seeing signs of capex, because at some point we'll see as demand continues to pick up, the capacity utilization starts to go up, and we'll see corporate capex. At the end of the day, corporate capex has to come back. If the economy has to do well, GDP has to do well, taxation has to do well, financials have to do well. It's all linked. So at the end of the day, somewhere the animal spirits have to come back. We think that it is somewhere very close. I mean, we are not too far away.
Sridhar, post the COVID rally, the space that dominated mind space screen was platform companies and mid-cap IT companies, the whole digitization theme. We've seen a brutal correction in most of those names. Are you buying again here?
See, the new age companies which have got listed, that we have broadly stayed away. You call it platform, you can do whatever you want. A lot of them are concept stocks right now. I mean, earnings is quite very far away, and unfortunately we've lived through 2000, and where all of us have made mistakes. At least I know I made a lot of mistakes. Infosys, Wipro were trading at 50 times revenue, and we were still buying them. And I think those scars remain in your mind. It doesn't go away so fast. So I think you may call me an old style investor, but having made those mistakes, it's very difficult to make the mistakes again. At least I'm calling them mistakes right now. I don't know whether they are mistakes or not. But unless I see some trajectory for profitability, I'm not buying this concept stocks where I can't see any and keep in mind that they themselves are getting disrupted by the day. I mean, you take the payment space. I mean, every day there is a disruption, and the business models are changing by the day. So I think I'll be very cautious there. I have so many other stocks to buy. I mean, the opportunity is increasing by the day. So I'm not in a hurry to stand there in the queue.
But I'm glad you brought up this point of disruption. There's disruption in every sector right now. I mean, if you talk about autos,
yes,
the traditional guys are getting disrupted by EVs. If you talk about NBFCs, they're saying a lot of the customers are now moving to fintechs or to the traditional banks. So there's so much disruption happening. How do you what are the changes that you keep making in your portfolio?
So I think the next 5 years, I think our traditional investment philosophy was buy a good company, just hold on to it for 10 years and sleep. Unless, the promoter is, has made some errors. Broadly, that's how it used to work. But I think those sort of metrics and the philosophy is now definitely changing, because as technology is improving, as new, disruptions, as you mentioned, are coming, you have to be constantly on your foot. Fortunately, I would say that, especially in the financial market, Reserve Bank has been, I would say, putting their foot down on a lot of disruptions where they think that it isn't backed by proper security and customer protection. So fintechs, at least their lending opportunities are reducing. the regulatory arbitrage for NBFCs have been significantly cut. So when I said financials, banks look very good is also because some of these disruptions which were very imminent in the last 1.5 years are sort of reducing because the way Reserve Bank has behaved. But in autos, I clearly agree. You look at even in say, in utilities, I mean, the way the alternate energy platforms are coming up. So I think there are a lot of disruptions that we could see. I would agree with you that the traditional way of buying and holding is surely not going to apply in the next 5 years.
IT services, because of the view on global economy, etc. You think you're going to stay away, or you think there's enough damage there?
So it's very selective. I broadly see one of the myths with IT services is that when currency depreciates, they do very well. I mean, this is such a big myth. Take the last 6 years, for example. Currency has depreciated roughly about 45–50%, and margins for every companies are down.
But stock prices are up.
That's a totally different. The stock prices are up because in between they started to do well in terms of their revenue. So they started to show strong double-digit growth. So when companies are showing strong double-digit growth, you buy them. If you think it's cyclically they are heading into a period where there are strong headwinds, I would say you should be underweight. I mean, that's my personal view. And currency makes no impact whatsoever. I mean, you go back 5 years, 10 years, 15 years, if they were really doing cutting edge digital stuff, then their margins should have gone up. So what I'm trying to say is that you look at the attrition of these companies and how many number of people they're hiring. I mean, they're having 20–25% attrition a quarter. I mean, that's staggering. So, and the salaries of these entry-level engineers haven't gone up for almost 10 years. I mean, they used to be 3–3.5 lakhs. It's now 4–4.5 lakhs. So I think, I question whether they're really doing cutting-edge stuff. Yes, they may be doing 10%, 15%, which is really high-end stuff. Most of the other is.
So you like the space, or you?
I would be underweight the space. After all this, I
underweight the space. Okay.
So there's clearly, I mean, from at least the conversation that we're having, I'm getting a sense that you believe that there's really no room for complacency, right? For a
100%.
lot of these companies, the traditional guys may not do well and have not done well. So what is the next space to look at? Is it renewable energy? Is it electric vehicles? There are so many new age spaces.
As I mentioned, that one, as I said, was financials. The other one is China Plus One is an opportunity which is really opening up for India, and it is not just in, say, chemicals. There are other opportunities. Now we are seeing even Apple announcing that the Apple 14 will be manufactured in India. So there will be opportunities which are opening up which were not so traditional. So one has to be very nimble in trying to look at some of these opportunities. I just gave you 1 or 2 examples, but there are many more opportunities which are opening up which were not there earlier. So because of one, maybe possibly disruption, 2 changes which are happening globally in terms of trade, those are the opportunities which one would look at. But more, I would say the domestic plays would be far better right now, given my earlier construct that globally things are not looking good. So if I were to invest, I would have more opportunities in the domestic space.
So last question then. It's very interesting, right? In India, we never got to the bear market territory. We were down 18% only. Globally, of course, there was clearly a bear market. So is there still a bear market rally, or is this a fresh bull market? And what's your view?
It's tough to say. I would say it's a bull market rally. I mean, it's a correction, a bull market correction that we saw. And our markets are flat for the year. So actually, we haven't really faced the brunt. But a lot of the other emerging markets or even European markets are significantly down. So I think we have done extremely well. I mean, which is one of my points that FIs were selling left, right, and center in the last 12 months. But it was quite intriguing that it is possibly one of the best markets to invest. And now when they come back, they'll have to pay a much larger impact cost to get back into this market.
We've already seen that actually play out, right? Over
Just
the last
1 month of FI buying, we are seeing an impact cost.
Absolutely, absolutely. And it's not even 5% of what they sold, and the market's almost back to highs. Sridhar, thanks a lot for
Thanks a lot. Yeah, thanks a lot.
Okay, well, the market is looking really good. I mean, you can't deny that. 100 points higher for the Nifty.